So here we are looking at the shortcomings of mutual funds with what we'll call the cons, and you can see the list is pretty big. Mutual funds, they hold large positions. As we saw in the software mutual fund, 60% of its holdings are in 10 companies. And so these are pretty large positions. So you're looking at companies like Microsoft and Oracle. So they have a very large float of shares. And therefore, these are pretty big positions in these companies. And so when things are not going well, it's hard to liquidate. A mutual fund may have millions of shares in a particular company, and therefore it's really hard to liquidate a million shares if something goes wrong with their picks. And so in fast moving markets or downward moving markets, mutual funds generally have a hard time liquidating such big positions. Their performance gets affected. Now, mutual funds costs are also high because there's a lot of churn happening in the mutual fund itself. And so there's a lot of buying, there's a lot of selling. Mutual fund costs are quite high when you compare them to ETFs, which we'll look at in the next section. Now, also, the net asset value of the mutual fund is set at the end of the trading day, after the trading day is over. And therefore, a mutual fund does not trade during market hours. Again, if you're looking at a big crash intraday, there's no way to get out of the mutual fund until the end of the trading day or until the trading day is over. And then the net asset value is calculated based on the closing prices of all the stocks. And so now, as you can imagine, if it was a very big down day and stocks really took a beating, then your net asset value is calculated based on the closing prices. And therefore, this is also a limitation. Inability to go short is also a big limitation. So they can only go long as per their charter. ETFs actually tackle a lot of these issues. And so ETFs are actually attracting a lot of money from mutual fund investors. And in mutual funds, as we said, there is a lot of active management. So there's a lot of timing the stocks. In general, it has not produced great results. Of course, we saw the fund, the software fund from Fidelity doing very well. But you have to bear in mind, there are thousands of funds. And so we happened to pick one that was a good performer. But in general, the majority of mutual funds have pretty poor performance. Now, I want to go and show you an article where we discuss the case against mutual funds and why ETFs are becoming so popular. So let's go take a look at that. So here's an article published by Eagle Daily Investor, the case against mutual funds. And so they say a few different things. I want to just run through some key areas here. At the latest conference in Chicago, this is a 2016 report. At the latest conference, there was a conspicuously absent discussion of what I think is the biggest threat to the mutual fund industry, the rise of ETFs. ETF market is the fastest growing market, growing at roughly 25% a year, and now has almost $2 trillion. But in comparison, the investments into mutual funds is 18 trillion. So almost 20 trillion, 10 times the size of ETFs. So mutual funds are not something to be sneezed at. They have a very big base, not only in the US, also around the world. But the fact is, ETFs are gaining ground on mutual funds. Here, what they do is they are making the case against mutual funds. And so one is high fees. So the cost of owning an average mutual fund is much more than an ETF. Why does this happen? It's because of the churn that happens in a mutual fund. Whereas in ETFs, as you'll see, the ETF tracks an index. And so that's different. Here, there's a lot of churn. The fund managers want to stock pick at appropriate times. Sometimes it works, sometimes it doesn't. But regardless, when you move in and out, there's a lot of cost because, you can imagine there's brokerage costs. Although for the big mutual funds, the brokerage costs will be lower. But still, if you're buying 500,000 shares or 1 million shares, that's going to impact the fees of the mutual fund. Then the mutual fund itself puts in a 2% management fee. And so all of that tends to add to the high cost of mutual funds. Taxes also, because whenever you have a high turnover of positions, leads to higher taxes for mutual funds. Because ETFs follow indexes and stick to their positions, it results in a lower turnover. So these are just some of the negatives of mutual funds. And like we said, mutual funds don't beat the index. They're tracking. The active managers are constantly looking to generate profits, and so they go in and go out. And in general, many of these tactics don't work. We saw a very good fund in the Fidelity software, but not all funds have that kind of performance. And so the active management really plays negatively into the mutual fund performance. And then there are a few other factors as well. Lack of access. Mutual funds do not invest in commodities, currencies, nor do they give the flexibility of ETFs, access to investments like single countries, sectors, emerging markets, etc. So, and there's here they go to say there's very little innovation. This is what I mean. During the financial crisis, many investors who redeemed their mutual funds during the bottom saw their investment sink in value. But if you were a newcomer to financial markets and you did not want to do the research, you can certainly go in for mutual funds. Just be aware of these issues we've spoken about here. Even if you're new, in the next section, we're going to look at ETFs. Now, this is really a very innovative product that has come up in the last 10, 15 years. ETFs is basically very similar to mutual funds, but they take away many of the disadvantages of mutual funds. So let's go into the next section and we'll discuss ETFs in detail.